Costco stock is now more expensive than Apple, Microsoft and Nvidia, based on a P/E ratio basis. Yet it sells toilet paper and hot dogs. How is this possible? Welcome to Investing Edge with Eric. In today's video, we'll dive into one of the most beloved businesses in the world to answer one question. Is Costco one of the most overvalued stocks in the S&P 500 right now? I've gathered 5 years of financial data and I've projected the next decade to figure out if Costco's valuation actually makes sense or if investors are setting themselves up for disappointment. As always, we'll go through 4 key sections, ending with a fair value estimate, an expected annual return of the stock, and a final star rating of the investment as a whole. So yeah, let's get started with the first section, being a brief introduction to Costco as a company. Here we are at Costco's own website. So Costco is a membership-based wholesale retailer, basically the king of bulk shopping. Founded in 1983, Costco has nearly 875 locations across the globe with a cult-like customer base and legendary employee retention. But here's what makes Costco different from every other retailer. It doesn't really make the money from the stuff it sells. Costco's actual profit engine is its membership fees, those $60 and $120 annual payments from over 130 million members globally. That's where nearly all of its net income comes from today. So the rest, well, it's basically break even. By selling products at near cost, Costco creates an insane loyalty and traffic, driving a flywheel of low prices, high volume, and steady growth. So its iconic warehouses, razor-thin margins, and absurd customer satisfaction scores makes it an amazing business. But is it an amazing stock at this price? With a P/E ratio of over 50, investors are treating Costco more like a high-growth tech stock more than a discount warehouse. So here's the real question. Can Costco grow fast enough to justify this premium valuation, or are we witnessing one of the biggest disconnects between business quality and stock price in the entire S&P 500? So now we have a sense of what Costco does as a company. Let's go to the second part of this video, which is the financial analysis, and see some historical data and assess how the company has performed. So before jumping into our model, let's go through the analysis structure just quickly. So we're targeting to get an estimated annual return of the stock and a fair share price of the company as well. To do that, we'll need 2 price targets, the enterprise value price target and the free cash flow to equity price target. And for the fair share price, we'll do a discounted cash flow analysis as well. Right, so here we are in our model. We'll focus on the enterprise value data, which is here at the top. And we have data all the way back to 2020. So yeah, the revenue has grown quite well, right? Consistently on average 11% per year. We can see that the EBITDA has grown at 14% per year, which is a good sign for us as investors. This shows us that the company is becoming even more profitable as it grows. At the same time, debt has declined 5% on average per year. That's a good sign, of course, for us as investors. And excess cash has really risen, right? By 111% per year on average. Now, this is, of course, 2020 and 2021. We can see a big jump in excess cash. The market cap has grown 25% per year, and that is, of course, much larger than the EBITDA or the revenue. Here's we can see that the multiple of the company is expanding and it's becoming less attractive for investors to buy today. The enterprise value has grown in line with the market cap, of course, at roughly 24%. Another example of where the company is becoming more expensive for us as investors is the enterprise value to EBITDA ratio. In 2020, it was around 25 times, and today it's around 34 times. At the same time, we can see that the EBITDA margin has been quite flat at roughly 4% on average per year. And the debt to EBITDA has been around 1.3 times, which is good for us. We're targeting around below 3 times on the debt to EBITDA for an investment. So the numbers have been quite good so far. Of course, we're seeing that the company is becoming much more expensive to buy on a relative valuation basis. Let's continue on the free cash flow to equity data, which is this table right below. So starting off with the operating cash flow, we can see that it has grown at roughly 6% per year. This is below the revenue growth. This isn't a good sign for us as investors. At the same time, CapEx has grown at a higher rate of around 10% per year on average. Looking at the shares outstanding, we can see that they have grown at 0% per year on average, so remained quite flat. This is a combination of the company buying back stocks, but also issuing share-based compensation, so the net effect is essentially 0% per year. We can see yet again that the average share price in this case has risen 24% per year. That's in line with the enterprise value growth per year, suggesting that the company is becoming more expensive on a relative basis when the operating cash flow is just growing at 6% per year. Now we have a few ratios here. We have the free cash flow yield, for instance. We can see it's around 2%. Quite flat throughout the years. It was much higher in 2020. It has declined in recent years. And the free cash flow margin is on average 2% for the past 5 years. Interesting to note is, of course, that the free cash flow to equity has declined on average by 2% per year, which isn't a good sign for us as investors. Now, this is due to a combination of operating cash flow not growing in line with revenues, capex growing at a higher rate, and the company paying down debt at the same time, which reduces the available cash flow for equity investors. So now we're going through the historical financial data of Costco. Let's give the company a first price target based on the enterprise value data that we have, which is this table here to the left. Now what we're doing here in essence is that we're applying a growth rate to their revenues until the year of 2034. In my case, I've applied 7% for a few years, then 6%, and then 5%, assuming that the revenues will decline slightly in the coming years to come. Now, the 7% is in line with the recent growth rates, looking at 2025 Q1 and Q reported numbers. Using these assumptions and applying an EBITDA margin of 4%, which was in line with their historical average, and a long-term market multiple of 25%, which is slightly lower from where they are today, reflecting a slower growth rate, we get a market cap of $441 billion in 2034. Also assuming that the shares will grow at 0% per year, this gives us an enterprise value price target of $996 in 2034. Now, let's also give the company a price target based on the free cash flow to equity. In this case, we're applying the same logic. We're using the growth rates per year until 2034. And we're also applying a long-term free cash flow yield of 2.5%, which is slightly higher than we are currently with Costco stock. That gives us a long-term free cash flow to equity price target of $928 per share. Now we're weighing them equally, and we can see that we get a weighted price target of $962 per share in 2034. Now we're going through the historical financial data that we have of Costco, and we're also given the company 2 price targets. Let's give the stock also a fair share valuation of where the stock should be today. Right, so jumping back into our model again, what we need to do is we need to discount all the future cash flows to a present value of today. Applying that logic, and if I scroll down a bit, we can see that we get a fair share price of $613 per share, and that's a 33% premium versus the current share price of Costco stock. In essence, summarizing our valuation of Costco stock, we can see that we will get these strings of cash flows in the coming years. We'll of course have to buy the stock, we will sell the stock, and that will be a cash-on-cash return of just 1.3 times until 2034. As I mentioned, we got a fair share price of $613 per share. That's a premium of 33%, and that's also just an IRR of 3% per year. That's the expected annual compounded return that we as investors could expect from Costco stock all the way to 2034. Another interesting table is looking at what happens to the IRR if the stock price goes up, which is red, which is bad, or if the stock price goes down, which is green, which is good for us as investors. We can see if the stock declines by just 40%, the IRR becomes 9%. That's in line with just market expected returns. If, however, the stock would increase by 40%, then we could expect a negative annual return from the stock going forward all the way up to 2034. So now we have a stock valuation for Costco. Let's give the company as well a final rating to see if this is stock that we really should stay away from or something that we could perhaps buy sometime in the future. So starting off with the financial performance, we can see that the company does not have a very strong revenue growth, at least not in the recent years. I've given the company 3 out of 5 on that one. However, the company is becoming more profitable. It has strong EBITDA growth, so I've given them at least a 4 out of 5 here. With that said, we saw also that the free cash flow to equity was actually declining in the same time period. So here I had to give them a 1 out of 5. We have, however, low EBITDA or debt to EBITDA of below 3 times, so that's a 4 out of 5. And we have a very consistent stock performance. I've given them 5 out of 5 on that one. Now, in terms of valuation, this is where it becomes really interesting. Do we have a high RRR versus the expected market return? Well, of course we don't. That's a 1 out of 5. And is it well priced versus its fair share price? Well, I wouldn't say it's the most overvalued company in the S&P 500, but it's definitely up there, right? 33% premium is a steep premium for investors. I've given them just a 2 out of 5 on that category. Ending with a few positive notes for Costco, I've given them 5 out of 5 in terms of competitive positioning. That's, I think, is a clear choice. In terms of strong brand reputation, that's also a 5 out of 5. It's a beloved brand by its customers and partners. And in terms of legal and macro risks, I've given the company just 3 out of 5 stars. That's of course because they sell at least physical goods, right? It has to do with recent Trump tariffs, uncertainties worldwide with economic growth, etc., etc. Now, to conclude, I would say that Costco is definitely overvalued. Regardless how you square it, the company is too expensive to invest in, which is a shame. Costco is an amazing company, it's an amazing business, which makes its employees and customers very happy. Now, even though this stock is not the most overvalued company in the S&P 500, I don't think that it should be in the same range as Microsoft, Nvidia, Apple, etc., etc. Hopefully in the coming years, if for whatever reason the valuation comes down and the growth remains steady and consistent, I think this is a great buying opportunity for many investors out there. Thank you so much for watching this video. In the link in the description below you can find a complete one-pager with the full 5 years of financial data used, the DCF assumptions and the forecast summary as well. So yeah, please like and subscribe. I'll see you in the next one.